Hi there. Many UK families believe estates under 325,000 avoid inheritance tax completely. In this video, PTA explains why that assumption can be misleading and how HMRC actually applies IHT rules.
Inheritance tax. Let's be honest, just the name itself can sound complicated, and it's easily one of Britain's most disliked taxes. But here's the thing. With some huge changes on the horizon, a lot of what you think you know about it, well, it's about to be wrong. So today, we're going to cut through all that noise, especially when it comes to that one magic number everyone seems to know, £325,000.
Right, let's kick off with a number that should really grab your attention. £9.1 billion. That's the absolutely eye-watering amount the government is set to collect from inheritance tax just this year. And trust me, that number is only heading in one direction.
You know, when the numbers are this big, you really need advice you can count on. That's precisely why this entire breakdown has been developed by the expert tax advisors over at My Tax Accountant. They've dug into the data, they've analyzed all the upcoming changes for 2026 and beyond, and together we're going to make sense of what it all means for you and your family.
So, here's our roadmap. First, we are going to bust that £325,000 myth wide open. Then we'll uncover what your real tax-free allowance actually is. After that, we'll get into the massive shake-up coming for businesses in 2026, and the next big change for pensions. And to finish, we'll lay out a clear plan to help you navigate this whole new landscape.
All right, let's get straight into it. That figure, £325,000, the one everyone quotes down the pub, well, relying on that number could turn out to be a very, very expensive mistake. Let's find out why.
So, how come more and more ordinary families are getting caught by inheritance tax? It all comes down to a little something called fiscal drag. Just picture this. The value of your house has been creeping up and up over the years, right? But the tax-free limit, it hasn't budged an inch. So suddenly, without you doing anything, your estate is worth more than that limit, and bingo, your family gets a tax bill. It's often called a stealth tax because the government collects more money without ever having to announce a tax rise. Clever, eh? And look, here's the proof in black and white. The main tax-free allowance, which is officially known as the nil rate band, was set at £325,000 all the way back in 2009. I mean, just think about how much house prices have shot up since then. And yet that threshold is completely frozen in time, and it's expected to stay that way until at least 2031. This is the one detail that catches so many people out. Now here's a little did you know for you. Despite everything we've just said about fiscal drag, currently, less than 5% of estates in the UK actually end up paying any inheritance tax at all. But, and this is the important bit, that small number is rising. That's why understanding your real allowance is so crucial if you want to stay on the right side of that statistic. So with that in mind, let's finally put that £325,000 myth to bed and look at the real numbers, what most people can actually pass on to their loved ones completely tax-free. Okay, here's where most people get confused. Your allowance is actually made of two different parts. First, you've got that £325,000 nil rate band we've been talking about. That's your basic, everyone gets it allowance. But on top of that, there's a really important extra one called the residence nil rate band. Now, if you pass your main home on to your children or your grandchildren, you get another £175,000 tax-free. So, you add those two together, and the real tax-free starting point for one person is £500,000.
But it gets even better for couples, because there's a huge advantage. This bit is a real game changer. Any allowance that isn't used when the first partner passes away can be transferred over to the surviving partner. It's such a simple rule, but it is incredibly powerful because it effectively doubles your potential tax-free pot.
And what does that mean in reality? It means this, £1 million. When you put all of that together, a married couple or civil partners can pass on up to £1 million completely free of inheritance tax. That's the number most families should really have in their minds, not £325,000.
Okay, so that's the personal side of things covered. But now, we need to talk about the really big changes that are coming for business owners and farmers. And stay with me here. This next point is going to affect nearly every small business and farm owner in the country. We're talking about two key reliefs, known as APR and BPR, and they are about to be completely overhauled.
The difference is pretty stark. Right now, up until April 6, 2026, if you have a qualifying business or farm assets, you can pass them on with 100% relief from inheritance tax, no matter how much they're worth. It is totally uncapped. But from that date, that unlimited relief is gone. It's being replaced with a brand new, capped allowance. This is a fundamental shift in policy.
Let's make this simple. The new system gives you a combined allowance of £2.5 million. So, the first £2.5 million of your business assets can still be passed on with 100% relief, which means zero tax. But, and you'll definitely want to hear this part, any value above that $2.5 million threshold only gets 50% relief. In practice, that means it's facing an effective tax rate of 20%.
But just like with the personal allowances, there is some good news for couples. This new 2.5 million cap is also transferable between spouses. So that means a married couple can pass on up to £5 million of their qualifying business assets before that 20% tax rate starts to bite.
So, we've got the new personal allowances, the huge changes to business rules, but that's not all. The next major reform is taking aim at pensions. Now, for years, pensions have been an absolute cornerstone of IHT planning, mainly because they sit outside of your estate. Well, that's all about to change.
So the big question is right there on the screen. And from April 2027, the answer is a simple yes. Any money you have left in your pension pot when you die is going to be brought into your estate for inheritance tax calculations. This closes what has long been seen as a major planning loophole. For you, it means you can no longer think of your pension as being separate from all your other assets when it comes to IHT.
So how's that actually going to work? Well, the government is putting a system in place where your pension company can be told to pay the tax bill directly to HMRC. This means your family won't have to find the cash themselves to settle the bill before they can inherit the rest of the funds. It's a practical detail, but it just confirms that these pension funds are now firmly in the taxman's sights.
Wow, we have covered a lot of ground. Personal allowances, massive changes for businesses, and now the new rules for pensions. So the big question now is, what on earth should you do about all of it? Let's break it down into a simple, straightforward action plan. So here's my tip. There are 4 key things you should probably be looking at right now. First up, revisit your will. Honestly, with all these changes, it could be seriously out of date, especially if you're a business owner. Second, think about strategic gifting. Using your annual gift allowances is a really simple but effective way to start reducing the value of your estate over time. Third, reevaluate your pension strategy. The old advice to spend your pension last might not be the smartest move anymore. And finally, plan for liquidity. That just means making sure there's cash available to pay the tax bill. You don't want your family to be forced into selling assets like the family home or business. A simple life insurance policy can often be a very smart way to cover this.
And look, don't just take my word for it. This warning comes directly from the Chartered Institute of Taxation. They're pointing out that these new rules are going to be administratively burdensome and will likely increase the costs involved. This just hammers home the point that you really can't afford to ignore these changes and that getting proper expert advice is more critical than ever before.
So, let's quickly wrap this up with the most crucial points to remember. First, that $325K figure is a myth. Your real starting point is more like £500,000 or a full million for a couple. Second, that fiscal drag we talked about is quietly pulling more and more families into the IHT net. Third, for business owners, that $2.5 million cap coming in April 2026 is a really big deal. Fourth, don't forget pensions. From 2027, they'll be part of your estate for tax. And the final, most important takeaway of all, proactive planning has gone from simply being a good idea to being absolutely essential.
Okay. Now, it is absolutely vital to say that everything we have discussed today is for general guidance. Everyone's personal situation is completely unique, so you should always consult a qualified professional for advice that is tailored specifically to you before you make any big financial decisions.
If you would like to get that expert advice tailored to your own circumstances, then please get in touch with my tax accountant using the details you can see on the screen. They're the experts who developed all this analysis, and they can really help you make sense of these changes. Thank you so much for joining us, and if you'd like to stay ahead of the curve on tax changes just like these, please do make sure you subscribe.